The Fed just tanked the market. And I know some of you may be thinking, hey, what's the big deal? The Fed always tanks the market. Well, not in this case, because in this case, we broke out of the bear flag on the S&P 500. The jobs numbers came out last Friday, showcasing the smallest number of jobs added in 2 years. Right after this, we had a market rally, and today the market was up 2% before Bostic came out and basically said the same thing that the Fed has been saying all along, is that rates have to be held higher for longer. However, the market keeps making the mistake for some reason of not believing the Fed, not only seeing those relief rallies, but also looking at the bond market, you can see that rates actually dropped today, and the bond market is now pricing in a lower than expected inflation rate over the next 5 years. The bond market is pricing that the inflation rate will be at an average of 2.2% over the next 5 years. The way they determine this is by taking the difference of bond yields minus inflation protected bond yields. Usually that's supposed to hover around what the expected inflation rate is. The expected inflation rate is about 3.6%, and the bond market is pricing in 2.2% average inflation over the next 5 years. I'm not sure how the bond market can price this in. Looking at things like the inversion between the 10-year and the 3-month, this is the worst ever. We've never been in -1 territory, and right now we're in -1.17 territory. So in this video, I'm going to tell you how the Fed just tanked the market, why that is a dangerous thing, especially the fact that the market is somehow pricing in events that are different than what the Fed is projecting or what the Fed is telling us they're going to do. Obviously, it's a huge week with CPI coming out this week. We are going to be live. Don't miss that. We will be live streaming the CPI. We also have the Fed meeting coming out on February 1st. Without further ado, let's get right into it. So as I said, the market was actually having a nice rally day, a 2% rally day. However, it tanked and fell back into this bear flag. This is the SPY that tracks the S&P 500 after Bostic came out and basically said the same thing. The Fed meeting minutes were released last week, and we did a video on this. Go back and watch that, but he's not saying anything different. He just said that they're going to be holding rates higher for longer, and likely the rates will be above 5%. Even the Fed has projected that the rates will be above 5%. This is not news. However, because the market has been beaten down for so long, there is this tendency to take every bit of good news and exaggerate it. So when we had the jobs numbers come out last Friday, showing that the US added the fewest number of jobs in 2 years, well, then the soft landing prospect became more realistic to the market, even though I still think it's not realistic at all, and the Fed has never achieved a soft landing. Now, obviously, for a trader, this type of volatility provides juicy opportunities, but for an investor, I think there is still a world of hurt for investors here. Now, I do think most of the hurt has taken place, meaning I don't think that it's going to get as bad as it was since January of 2022. I do think we will break the lows that we saw in October and at least get back to the pre-COVID highs. So from my standpoint, I think most of the damage is done, but a high interest rate environment is not really good for mega cap stocks. Now, I'm going to get back into a market analysis from an investor's perspective, but like I said, from a trader standpoint, this is providing a lot of lucrative opportunities. I'm going to be longing the 10-year treasury once we hit this trend line here, because I do think that rates are going to go back up, especially since I personally think that the Fed is not going to pause on February 1st. I do think that they will continue to raise rates, and the Fed is trying to maintain as much credibility as possible, because the one thing that they're afraid of more than inflation is inflation returning. And just like Michael Burry had stated, and I also did a video on this, but basically his prediction actually is that the CPI is going to come down significantly in the first half of 2023. That's going to fake out the Fed. The Fed will actually go back to quantitative easing, and then inflation is going to return like a bat out of hell. I also went over the history of this in the early 1980s. That same very thing actually happened before Paul Volcker came in and pushed rates up to 20% and said enough is enough. But inflation did go away for some time and then came back roaring to a double-digit 13.5 inflation rate before Paul Volcker did raise rates to 20%, as you see here. But as long as the market doesn't believe it, that is going to provide us some opportunities. I will be looking at shorting the 10-year and 2-year Treasury futures very soon. We've also been day trading this volatility on the futures. We had a short on the NASDAQ today. Didn't quite get the entire move down, still ended up profitable. We had a long on the S&P 500 last week, the S&P 500 futures. Got a nice $650 per contract out of that. We are 5 for 5 on our last 5 futures trades. I'm in an Apple short that's currently down. But if you want access to all of my trades when I'm going to be longing or shorting the Treasury futures, my day trades on futures playing the volatility, my trades on FOMC, on CPI day, my long-term trades, my long-term holds, my analysis. I just did a whole thesis on Tesla. We also have the Zoom calls that we do every single month, where we get on for 2 hours and you get to ask me any question about trading strategy, about how to trade futures, how to trade options, etc., anything that you're stuck on. It's really a vibrant group full of thousands of traders. Would love to have you. If you're interested in applying, hit that link in the description. So as I said, I do think that we have to believe the Fed if they're saying that they're going to take rates higher for longer. And in January, the CPI report that's coming out on January 12th, again, we will be live streaming that. The expectation is that the CPI comes in at 6.1%. The last CPI came in at 7.1%. So could we come in a full percentage point less? Sure, I guess it's possible. I don't really have a good way of knowing. You know, from an anecdotal standpoint, I do still think that prices are sky high. Any of you that have visited the gas station or the grocery store would know that. Even if we come in at around 6.1%, the fact that the jobs numbers or the unemployment rate is going down, actually. This is the lowest that it's been since 1969. Even though we've added the fewest number of jobs in 2 years, this is very concerning to the Fed. So even if we come in at 6.1%, as long as this remains low, the unemployment number, then I think the Fed will continue to hike. And right now, it's expected that the Fed does a 25 basis point rate hike. Now, if the CPI comes in much higher than 6.1%, I do think the market continues to tank. If the CPI comes in at 5 point something percent, then I do think that the market actually has a chance to rally and do a violent rally as well. If the Fed does higher than 25 basis points, because that is what's priced in, I do think that the market will tank. However, let us take the overall picture, right? If we look at the SPY, let's take the overall picture here. The overall picture is, to me, still pretty grim, because if the Fed has to keep rates higher for longer, we know that all of the yield curves have been inverted, and we just had an inversion on the 2-year with the effective federal funds rate. This precedes a recession each and every single time. Again, the 10-year 3-month is at the worst that it's ever been. This precedes a recession every single time. So I do think we will fall into a recession because the Fed will have to keep rates higher for longer. Now, I heard on CNBC, what happens if we don't get the earnings compression that we think we're going to get? What happens if companies report better than expected earnings? Well, if companies are reporting better than expected earnings, then it's likely because inflation is still around. I don't think that inflation can go down while companies report better than expected earnings. If companies are reporting better than expected earnings, that means that spending isn't curbed yet. Now, that's possible, but that would also mean that inflation would be sticky or would have to remain sticky in order for that to happen. You can't have, your cake and eat it too. So either spending comes down and inflation comes down, or spending goes up and inflation stays around. And at that point, it just becomes a matter of timing. Like, is earnings compression going to take place in this next round of earnings that we see at the end of January? Is it going to take place in Q2? Who knows? I'm not Nostradamus, and neither is anybody else. But I think that if the Fed is serious about fighting inflation, then the war with the stock market is not over yet. And I do think we will break those October lows. And I think that Apple is really the last stock to drop. We've seen stocks like Tesla. We've seen every stock under the sun drop. And Apple is the only one, although it has dropped, is the only one that has remained relatively high, still trading at 130. That is why I still maintain a short on Apple. Now that expires in over a month. And like I said, currently it is down a little bit. But as I stated on my Twitter on November 8th, I said when Tesla and Apple start dropping to levels that retail traders gasp at, we'll be near the bottom of the bear market. I don't think the bottom of the bear market happens without Apple hitting new lows. And by new lows, I mean lows that we haven't seen since at least 2021. Now, Tesla already did that. And I think a lot of Tesla fans can't believe the price that Tesla is at, but I do think that Apple is the last to go. Now, in terms of building a portfolio, I don't think, in my view, I mean, this may be an unpopular opinion, but if this isn't enough for you to invest and you were happy buying the highs, then I think there is something very wrong with the way that the modern day investor thinks, right? I'm not saying pour all your money here. I'm just saying that you have to start thinking about investing around these levels, right? Either dollar cost averaging or at least prepping a portfolio of stocks that you want to invest in. If you're not willing to invest in the NASDAQ down over 30%, almost wiping out all of the 2020 gains, but you're more than comfortable investing at the NASDAQ near 400, then I think something is really wrong with people's investment strategy. Because for me, stocks are starting to look attractive. Again, this isn't an all-in level for me, but I can't deny that this type of discount is something that usually you'd have to wait a lifetime for, right? There aren't that many bear markets in one's lifetime. Now, lastly, I'll just say if the Fed raises 25 basis points on February 1st, we'll be around 4.5 to 4.75% on the Fed funds rate. And remember that the Fed has to raise rates until the rates are above CPI. So it becomes this game of chicken between the Fed funds rate and the CPI. And, if CPI can come down significantly, right, and we start getting into the fours and the Fed funds rate is now, in the high fours, then at that point we could start to think about, the bottom of the market, because I do think the market will actually bottom out during a recession. The market doesn't wait until the recession is over to bottom out. It usually bottoms out in the recession itself, in the economic recession itself. But I do think we will hit a recession. I do think the market does have more to drop, but I don't think we're going to get another 30% drop in the market, meaning that we are closer to a bottom than we are to a top, in my view. Anyway, traders, that is it for this video. Again, we are going to be live streaming on January 12th, so peep out for that. Also, if you want access to all of our trades analysis, all of our trades in real time, if you want access to the community with thousands of traders where you can ask any question, bounce ideas off of, get questions on any strategy, questions on options tutorials, futures tutorials, link is in the description below. It is a great value. Also, you get access to the Zoom calls with me. We are going to be doing a Zoom call this weekend. Excited for it. Can't wait for it, for our mastermind Zoom call. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.